This chapter is about what the enterprising investor should do. The enterprising investor is someone willing to spend time, thought, and effort to try to beat a plain, passive result. He or she still begins with the same base as the defensive investor, a mix of high-grade bonds and quality common stocks bought at reasonable prices, but then looks for extra, justified opportunities. The chapter lays out the practical, positive ways an enterprising investor can try to add value, and which of those ideas tend to work in markets and why. There are two big categories of opportunity for the enterprising investor. The first one is special bond opportunities. Examples include tax-free new housing authority bonds backed effectively by the government, taxable but high-yielding new community bonds with government guarantees, and municipally issued industrial bonds serviced by strong corporations. These are bond niches an enterprising investor might pursue after doing homework on structure and credit. The second category of opportunity is common stock strategies. The chapter groups these into 4 tactics. 1. Buying in low markets and selling in high markets. Market timing, but done with rules or discipline. 2. Buying carefully chosen growth stocks. 3. Buying bargain issues of various kinds, deep value picks. 4. Buying special situations or workouts, reorgs, arbitrage, takeover targets, legal/structural events. The authors admit that simple market timing formulas rarely work in the modern era. The swings since 1949 have been irregular and would have required special trading talent to exploit. So the enterprising investor should not expect an easy buy low, sell high formula that reliably outperforms without skill. That said, a disciplined approach to changing the stock/bond split within the recommended floor and ceiling of 25 to 75% in stocks can make sense if you have strong, justified convictions. Growth stocks can be wonderful. Companies that increase earnings rapidly do create enormous gains, but the market often prices those expected gains into the stock. 2 risks for the enterprising investor. You can be right about future growth, but still lose if you paid too high a price up front. Fast early growth usually becomes harder to sustain as the company grows larger. Growth curves usually flatten. Empirical studies cited in the chapter show that diversified professional growth funds did not, on average, substantially beat broad indexes over long stretches. The practical takeaway: growth investing can pay off, but it's a hard, competitive game and often better left to skilled specialists or only undertaken with strict price discipline. The chapter recommends 3 approaches that combine sound fundamentals with being different from the crowd. 1. Relatively unpopular large companies. Buy big, strong companies, temporarily out of favor. The logic: big firms have resources to survive setbacks, and the market tends to revalue them once results normalize. Tests on the Dow showed that low price to earnings, low multiplier, blue chip groups often outperformed popular high multiplier groups over many years. Important caveat: avoid companies whose low price simply reflects a structural or permanent earnings deterioration. Book examples: Chrysler's roller coaster earnings show how cyclical companies can both reward and punish. Standard Oil of California, in the era discussed, is an example of a steady company selling at a modest multiple. 2. Bargain issues, deep value. A bargain is defined here as a security that, after conservative appraisal, appears worth at least 50% more than its market price. Ways bargains arise include A. Temporarily disappointing earnings, B. Market neglect or unpopularity, and C. Hidden asset or working capital value. The chapter gives historical examples. General Motors in 1941 selling at very low multiples, where diversified bets on many such bargains worked well. A net-net strategy also works well, which involves buying stocks that trade for less than a company's net current asset value, literally cheaper than the company's current assets, minus all liabilities. It's a deep value, margin of safety play. Key point: bargains are most powerful when purchased across many names, diversification, so isolated failures don't wipe out gains. 3. Special situations or workouts. These are technical opportunities, reorganizations, bankruptcies, spin-offs, takeover arbitrage, or securities mispriced because of legal complexity. Historically, these could be very profitable for those who knew the ropes. They require special knowledge, careful legal and accounting work, and patient timing. They're not for novices. Some practical rules and important limits. The enterprising investor must be disciplined and honest about competence. Don't be half a businessman. If you lack time, temperament, or skill, stick to the defensive route. Avoid common mistakes, buying popular growth stocks without price discipline, chasing IPOs, or treating speculation as investing. For secondary or smaller companies, the authors warn that the public tends to value them unreliably. That creates opportunities, but only if you buy them at genuine discounts to intrinsic or private owner value. When bonds or preferreds look attractive, distinguish between quality and yield. Second-grade bonds can yield more but expose you to principal risk unless bought at large discounts. The commentary confirms the chapter's central message: what you don't do matters as much as what you do. It underscores practical lessons. Growth mania and IPO crazes produce winners but many losers. The average investor is unlikely to consistently pick the big winners. Deep value and net strategies can work, but only if you can assemble many positions and hold through volatility. Special situations historically rewarded those with knowledge and nerve, but the field gets more crowded and complex over time. Diversification remains essential, even for enterprising investors. Concentration can make fortunes but also destroys many.